Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money to debt with the help of something called a line of credit. And a lot of people struggle with debt. I mean, I just had this video come up in my feed 1 hour ago. Credit card debt is crushing them. They ignored the warnings, and then you could see that these ladies are very worried about the credit card debt. Okay. But do not worry. Credit card debt will not crush us. We will crush the credit card debt. And if you take a look at statistics right here, average American carries about $6,700 in credit card balances. And the total credit card balance of the nation, I think, is 1.21 trillion. And 60% of consumers carry a balance each month. All right. So let's go ahead and get started with paying off our debt. We're just going to do the same review as last time because remember that Bruce Lee saying, do one kick 10,000 times. I don't know how many videos I made, but one day it will be 10,000. Okay. So, how do we do velocity banking? First step is a budget because a budget is a debt attack plan. Okay. Debt attack plan. And so we have our income, expenses, and then we have all our credit cards here. Look at that. How much credit card debt is this? Let's go ahead and add it up 15, 27, 30, 35, 12, 18. And then I'm going to go ahead and sum this up and that's $137,000 of credit card debt. $137,000. Okay. So we had all that credit card debt, but we will crush it. We will crush the credit card debt. Okay. Credit card debt will not crush us. And then we got the three loans, and then we got our what we call our general expenses. That's not debt, food, gas, insurance, $2,300. And with velocity banking, same income, same expenses. Okay. Same expenses, but we don't save money. That's kind of like the key to this, not saving money and then using a line of credit to help us pay off the debt, right? And so what does it look like? I can't speak right now. What does this look like in real life? Okay. So if we go up here, um, you see how money comes in and then it just goes out and there's nothing there? Boom, boom, right? Money comes in and it just goes out. And unlike most people, when they got a zero here, this is actually intentional on our end. Most people, they're freaking out about this, right? And so that's what we're going to do. And so we're going to have this number called cash flow, income minus expenses, that we're going to increase by moving some debt into the line of credit. And that's $137,000 of credit card debt. We're going to start off with that first. And guess what happens just by simply moving that debt, that $137,000? Well, these all go to zero, right? So we have these six credit cards, right? And they all go to zero. So this is going to be zero, 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 right? And then we literally, this is the part that's kind of like, whoa, is that real? Right? We literally went from $2.12 to $4,427.12. How do we do that? Oh, must be a scam. Anyways, all right, so let's go ahead and do the final step was we put the entire paycheck, $8,000 into the line, take our expenses out and then rinse and repeat over and over again by 4,000, or I'm sorry, rinse and repeat over and over again and we'll reduce the debt by about $4,427 minus some interest, right? And so let's go ahead and do that and I'm going to show you how what I always show you, which is G2 plus H2 minus 4427.12. And then what we're going to do is take the average daily balance, right? That's how we calculate the interest on a line of credit. Multiply by 0.08, divide by 12, and then we just rinse and repeat over and over again, over and over. And I know some of you watching this, especially if you watch this for the first time, you're probably getting some false hope because you think you could get a line of credit, especially if you're $2.12 short, right? And I'm going to tell you the secret of getting lines of credit that you probably won't want to hear, especially if you're new to this channel, right? I don't assume anybody here um, is all veterans, right? I know we got some good, nice fans who've been watching pretty much every single video. But for those who haven't been watching these videos or are new to the channel, um, I have over $604,000 in lines of credit. $604,000 in lines of credit. And you know what the secret to getting all those lines of credit are? And it might be more in like a month or so. Probably was it $60,000 more. We'll see. We'll see. In about a month or so, it should be $60,000 more. But you know what the secret to it is? Banks don't lend money to people who need it. That's the secret to getting lines of credit. Okay. So if you need money and if you need if you need a line of credit, they're gonna turn you away. They're like, this person needs money. No thanks. Because banks don't lend money to people who need it. So I'm gonna tell you a secret there. And if you understand that secret, if you understand how to get that line of credit, okay, how to get it, then you'll have access to the bank's money. 99.999% guaranteed, kind of like those Lysol germ commercials, right? I'm not saying 100%, can't 100% guarantee anything, but 99.9, if you don't need money, bank's probably going to lend it to you, okay? All right, so let's go back here. And then we see right here, 35 months, it's been paid off. 35 months. All right, that's cool. And you might be wondering, what's the cash flow index number doing here? It's just the ranking system of how we pay off debt. And so the lower the number, right, that's the one you want to pay off first. And you calculate it by the statement balance divided by the payment. You see the 15,000 divided by 487.5 gives you an arbitrary number, and then you pay it off. All right, so now this is going to be 35 months. 35 months. All right. How much was that? $137,000 of debt? Yeah, let's take a look here. $137,000 of debt. So we're going to do this, and then we're going to do this right here. Okay. And then now we have three debts, right? Three more debts, the amortized loans. So we want to tackle these debts first, because look at that high interest, right? Credit card have high interest. They take up a lot of cash flow when we're dealing with amortized loans. Not so much, right? A lot of people villainize amortized loans and say, hey, amortized loan bad. Line of credit good. And I say, why not get all of them, right? Especially, like, let's say I'm going to buy an apartment, right? And I'm not saying I have an apartment. I'm saying, let's say if I'm going to buy an apartment, someone gives me a 0% loan, I'm going to take that, right? I'm going to take that over 8% line of credit and then use both, right? So, all right. So now we see that in this loan calculator right here, we got a 13 grand balance left in our car loan. So what does cash flow index number mean? Basically, the lower the number, the more bang you get for your buck, right? To pay 13 grand, you get $552 back in your cash flow. 33 grand, you get 466. So I'm going to move this into the line of credit, this 13 grand, and let's get that $500 back in our cash flow. Okay, so this is going to be plus 13231 31.4, and then let's get that $500 back in our cash flow. And then I'm going to do this right here. So we got a new cash flow of almost 4,000 something dollars. And do this. So 4,979.62. Bam, bam, bam. All right. Bam, bam, bam. All right. So 38 months. Okay. So 38 months, we paid off 137. It's 167K. And then I'm going to put this right here. So this is going to be 38. All right. This is going to be 0. And then let's move this 32 grand into the line of credit and get the 466 back in our cash flow. All right, so this is going to be 0, right? But let's go ahead and copy and paste, right? Copy and paste. Where'd I go? Oh, by the way, if you're new to this channel, I paid off my mortgage in 2 years and 9 months. All right, so let's go ahead and do this. And I'm going to move this right here. All right, so plus 32869.23. And then this is going to be $5,445.99 in our cash flow. So it's going to be 5445.99. And then I'm going to copy and paste. And then blam, this is paid off in 44 months. 44 months. It's all paid off. Okay, 167 plus 45, and then that's 212K, and then the next is the mortgage. So let's do this in 44 months. So 0, 44, and then we see that the current balance of this really cheap mortgage, I mean, that's a very cheap purchase price for a home nowadays, right? I think the average home in Georgia is probably around 300K. I remember when I first came to Georgia, I saw all these houses in like prime real estate areas, and this is about like 2016, 2017, going for like 200 something K. And these were like two-story houses. And I was like telling and begging my parents, please buy a home here. They didn't listen to me. That house now would be worth about 800. So don't even need a tenant. You just need to sell and or maybe just get a home equity line of credit and access that cash and then buy some rentals or buy something, right? All right. So now this is gonna be 44 months, 250,000, 230, right? 230. Okay. And then latest balance is 230. So how do we defeat this 230 monster, right? Okay, we crushed the credit card debt. That was easy. That was easy. But how do we beat the mortgage? Okay. Now here's the thing: you could actually make an argument like you don't have to pay off the mortgage, right? Just buy some real estate, and you can do that too. But we're just be safe, conservative because when you pay off debt, it's like it's like a guaranteed return. Okay. Now, here's the thing that you might hear from other velocity banking people on the internets: just move your loan into a line of credit, right? First lien HELOC's awesome, right? And you can see here that if you move this 3% loan into an 8 or 10% line of credit, okay, might not go so well because you're literally giving away $230,000 for $1,000 a month in cash flow. Would you give that to, let's say, like an insurance company? Like, here, take my 230,000 that I have my savings, give me $1,000 a month, right? $1,000 a month. You'd be like, really? That's literally what's happening with the 30-year mortgage, right? And because it's such a little amount, you're not getting that much in cash flow back, right? People don't understand with amortized loans. There's three factors: the balance, the rate, and then the term that determines how much you pay over time, right? That determines the payment amount. And if you increase the interest rate, obviously the amount of interest that you pay over time increases. But if you increase the term, the payment goes down, but the interest goes up, right? So if you take a look here, okay, I do a 40-year loan, okay, and then right, so I pay a ton of interest. Actually, what's 40 times 12? I think it's 480, right? So I do a 40-year loan. I go all the way to the end of the loan, right? Look, I pay more. Okay, that's how it works. Rather than if I just do 30 and then do 360, 129. You see, we paid about $50,000 more by increasing the term, although the payment, I think it went down, right? See, people don't understand that. That's the scary thing about loan amortization. Now, where was I at? I don't even know. Just talking nonsense because that's what I do here. All right, so one easy way where you can pay off the loan is using something called the chunking method, where you take a small chunk of the loan, move it to the line of credit, and then just pay it off over and over again. Is this the most and fastest way to pay off the debt? Probably not, because if you take a zero, come up with the most extreme example. If you take a 0% loan and move it into a 10% line of credit or 8%, you're probably going to end up paying more, right? So depends on what you're going to move it to a line of credit for. But I'm just going to tell you something: the best financial decision ain't the best credit decision. Okay. But let's move it to the line of credit, see if it works or not. And let me go ahead and do that. Give me one moment. All right, let's take a look here. And so we see that 8,800 is the income, and then expenses, everything except for the loan we're trying to pay off. And we take a look right here. We just input all the numbers and we see that we paid off in 3.2 years. Well, blam. Well, blam. Look at that. That's pretty cool. And so I don't even know what to do with this spreadsheet anymore, right? Like I just typed it, it made the life a little bit too easy. to calculate my debt payoff, but 3.2 years to pay off a home, that's pretty good. That's pretty good, but not as good as 2 years and 9 months, which is my payoff time, but whatever, whatever. I'm just bragging, just flexing a little bit. Anyways, all right, 3.2 years, and then we just do that, and it's 44 divided by 12 plus 3.2. And in 6.87 years, we are debt free. We are debt free. You know, I have a confession to make. I'm so bored of making these videos, being debt free and not a mortgage free. You ever hear like in those velocity banking YouTube channels, it's like you could be mortgage free to 7 to 10 years. No, 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 no. It's mortgage free in about 3, and then completely debt free in about a little bit less than 7, right? And you do this so many times, this will be like your new reality, right? Like debt free in 7 years. Okay. And that's how it should be. And I think one of the things that people kind of highly underestimate is how boring success is, because when you master something, that essentially becomes your new normal. You realize that, right? And that's why, okay, so this is why, like, whenever you do something that you're really, really good at, you don't really get excited, and that's supposed to be normal. You see, most people, because they're getting crushed by credit card debt, it's like, um, finding drinkable water after sometimes, like, for some people it's normal, no big deal, but if all you've been surrounded by is like salt water, and then you find that drinkable water, that's like, whoa, this is like the best experience ever. Same thing with paying off debt. Like, you think, whoa, this is just kind of normal, paying off the debt so quickly. And then you realize, oh, no, wait, no, wait. That's maybe for me, it's true. But for everyone else, it's unfortunately, they're drowning. All right. So that's it for today, folks. Just another review of the same situation we did last time. But, maybe some of you are waiting for the comment at the end of the video. So what I mean by that is because I say, hey, if you want me to know that you paid attention to the end of the video, type in this in the comment box below. And what are we put in the comment box? All right, I got my phrase. I crushed my credit card debt, right? Because it's easy. Okay. So you don't have to put the it's easy part, but just type in the comment box below. I crushed my credit card debt. Okay. I crushed my credit card debt. That's how I know you paid attention to the end of the video. All right. Well, that's it for today, folks. Korean Latin Mentorship. Have a great day, and I'll see you all in the next video. And this has to be a 0. All right.